If you are planning to sell a property in India, then there is one choice that government has given you. And most people don't know about this, and it could save you lakhs of rupees in tax. So if you don't know about this choice, then you could be paying far more than you need to. In this video, I'll be explaining exactly how capital gain tax works after the budget changes, who gets this choice, and how to use the right option for your property. Before we get started, if you are new to our channel and you are interested in real estate or property related videos, then you are at the right place. Do consider subscribing us and do watch the video till then, because we will be sharing three important ways through which you can save taxes, and the fourth one is an absolute bonus and it is my favorite as well. So without further ado, let's get started. So let us first understand what is capital gains tax. So capital gains tax is the tax you pay on the profit you make when you sell a property. If you sell a property for more than what you bought it for, the profit is called capital gains. And the government taxes this profit. The key question is how much you pay depends upon one thing: how long you own the property. Here is the single most important number to remember: 24 months. So if you are buying a property and you sell it within 24 months of buying, then the profit that you make out of it is called short term capital gains, or STCG. So here the calculation is very simple. The profit is simply added to your total yearly income and taxed at whatever tax slab you fall in. So if your yearly income puts you into 30% slab, your short term profit is taxed at 30%. But if you sell a property after 24 months, the profit is called as long term capital gains, or LTCG. And this is where things got complicated after 2024 budget, and this is where the big choice comes in. So before 23rd July 2024, the long term capital gains tax was taxed at 20% with indexation. Indexation means the government allowed you to adjust the purchase price of your property for inflation, which brought down your taxable profit. But after 23rd July 2024, the default rule changed. Now the long-term capital gains are taxed at 12.5% without indexation. So here comes the tricky part. On ground, 12.5% might sound a better option than 20%. But here's the catch: without indexation, the taxable profit might be much higher, because now you'll not be able to adjust your purchase price for the inflation. That means the same profit could end up costing you more tax under 12.5% without indexation than under 20% with indexation, depending upon when you bought the property. And that is where exactly the big choice comes in. So now let us understand the big choice. If you bought a property before 23rd July 2024, then you are given a choice to calculate your tax between two ways. Option 1, the old rule, 20% with indexation, or option 2, the new rule, 12.5% without indexation. Here you simply have to pick a choice that gives you a lower tax bill. The government is giving you a choice, but if you bought a property after 23rd July 2024, you don't have a choice. You'll be taxed at flat 12.5% without indexation. And to understand this in a very simple way, I have explained this with an example and I have put it in the comment section. So please make sure that you check the comment section. And here is something that most people don't know. Even if you have a capital gains to pay tax on, government has given you three options through which you can reduce or avoid tax completely. But before we proceed, if you think this piece of information was helpful, then do like this video and make sure to share this with someone who needs this. So now coming back to video, the three options that government has given us to save tax or avoid tax is section 54, section 54F and section 54EC. Let us understand these three sections in a detailed manner. Let us understand section 54. If you sell a residential house and want to save tax, you have two options. 1. Buy a residential house. You must buy it within 1 year before the sale or 2 years after the sale of your old house. Option 2. Construct a new house. You must complete the construction within 3 years after the sale of your old house. If you either meet time limit, you can reduce or avoid capital gains. But there is one more condition here. The new house you buy must not be sold within 3 years of purchase. If you sell it within 3 years, the exemption is cancelled and the tax comes back. Let us understand section 54F. If you sell a non-residential asset like land, a commercial shop, or a building that is not your house, and you use the money to buy a residential house, the same time limit applies. That is, you buy a house within 1 year before the sale or 2 years after the sale, or you construct a house within 3 years after the sale. But there is one important difference here. To claim section 54F exemption, you must not own more than one residential house on the date of the sale of the original asset. Also, you cannot buy another residential house within 1 year after the sale or construct one within 3 years after the sale, or the exemption is cancelled. Now let us understand section 54EC. If you do not want to buy or construct a new house at all, you can invest your long-term capital gains into a specific capital gains bond like REC or NHAI bonds. The rules are very strict here. You must invest within 6 months of the date of the sale, not on the 7th month or next year. 6 months from the day of your sale, that's it. The maximum investment that you can make is 50 lakh, and these bonds have a 5-year lock-in period, so you cannot withdraw the money before 5 years, and if you miss the 6-month window, the exemption is gone. There is no second chance. But before we wrap up, there is one more bonus scheme that I'll let you folks know. So the bonus scheme is open a capital gains account scheme, that is CGAS, with the bank before your ITR filing deadline. Parking the money in CGAS protects your exemption claim while you look for the right property to buy. And this is one of the most useful tool that most people miss completely. Before we wrap up, I would like to say one thing. No matter how much research we do and how much effort we put into creating this video, it is your duty to go and personally meet a qualified chartered accountant, because he is the only person who will guide you how to invest your money and how to save your tax. And finally, if you found this video informative, then do like it and share it with your friends and family. And for more such videos, do consider subscribing to Real Estate with Kiran. Thank you for watching.